recording, and I see the recording tab, so I think we are ready to go. So good evening, everyone. My name's Mary. I'm with the Cincinnati Alumni Chapter, and tonight is our second installment of our Adulting 101 workshop. This one is about the lovely thing that we all will be dealing with, and that is taxes, withholding like a pro. The reason we called it this is because our presenter, which is Matt Whited, actually gave this presentation to the Cincinnati Bengals rookies earlier this year. So Matt is actually an initiate of the Alpha Upsilon chapter. So there we go. Okay, for Alpha Upsilon, and he is currently the president of the Cincinnati Alumni Chapter. Although I think you were also president of the Denver Alumni Chapter for a while. Is that correct?
I was just a member, but I was the DD out at Denver.
At University of Denver, that's right. So, and I think he also has been DD for Alpha Upsilon as well, although he does live on the east side of Cincinnati. And he is currently a senior tax manager at Clark Schaefer Hackett in Cincinnati. So we want to welcome Matt, and Matt, the screen and the microphone are yours. Take it away.
Thank you, Mary, and thank you everyone for participating. Appreciate it. We'll go over some tax items tonight. As Mary said, I did speak with the rookies for the Cincinnati Bengals earlier this year on similar topics. We're not going to go into exactly what they are going in or what we went into there, mainly because I think they're probably going to have a little bit more income than most of us will, as they're starting out. So we won't scare you as much as we scared them. Thank you for having me. I've been in public accounting for almost 18 years now. As Mary said, I lived in Denver for a number of years where I worked for Ernst & Young. I was a senior manager there. Moved back here about 5 years ago and a senior manager with Clark Schaefer Hackett in downtown Cincinnati. I did graduate from Miami in 2002. And so I know the area, I know the Oxford campus pretty well. So happy to have everybody here. So we'll go ahead and get started. I don't think the presentation is going to go as long as others have, but feel free to ask questions, and we'll make this as interactive and hopefully as interesting as tax can be for you. I don't know how many of us are in finance or in accounting or anything like that, but tax is something that we all have to deal with. As they say, you're guaranteed two things in life, death and taxes. So, withholding is going to be a big part as something that once you start going into your careers and something you need to be thinking about. Just a quick, couple thoughts on income tax accounting and why we have it and what it's for. It's the 16th Amendment of the Constitution, the income taxes, that allows the government to tax our income. Why do we need income tax? Well, governments need to have money, need to have a source of revenue to be able to run services and things appropriately. So that's the reason why they have it. Income tax accounting is not just on your W-2 wages. It's on your interest, your dividends, any rents, royalties, lottery winnings, if anybody hit the big one recently, unemployment compensation, and various things like that. So all those types of income does get hit and will be taxed. Generally, when we talk about income taxes and what we talk about in day-to-day conversations is the individual income taxes. There are corporate income taxes or taxes on trust and various things, but what we're going to talk about here tonight is from an income tax or individual income tax perspective. I don't know how many of those of you are from out of state. Most of us are probably from Ohio or the surrounding areas, but so in saying that, states and localities also have income taxes that are similar to the federal government. However, there are 7 states that do not have income taxes. Alaska, Florida, Nevada, South Dakota, Texas, Washington, or Wyoming. You'll be able to those states do not have any income tax with any individual income tax. So if you do live in one of those states, you don't have any state income tax that you need to be responsible for. Like I said,
hey, Matt,
this is the.
sorry, Matt, I have
Yeah.
one quick question. One of the things you've mentioned about the Constitution, it says it's a voluntary tax.
I'm getting there. Yep.
Okay. Oh, you're going to get there. Okay. Never mind.
There.
Okay. Sorry.
Yes.
I'm getting ahead. Okay. Yeah. I was just hoping you could just explain that. And I don't know if you're able to share your screen or not, so they can.
Yeah. Well, this is just the background right now, so I don't really have anything on that, but be more than happy to share, the entry slide here.
Okay. Sorry about that. Okay. Got it.
That's it. Whose screen is that? Can you see my screen? Yep. All right. So, as we were saying, the federal government, this is the federal government's top source of income. In 2017, individuals paid $1.66 trillion in income taxes, which was amounting to 48% of our federal revenues. So it's definitely a big thing and something that the government takes very serious. As Mary mentioned, it is a voluntary tax. It's a voluntary reporting system. It doesn't mean taxes are voluntary. It means it's a voluntary reporting system. So what that means is that you voluntarily report your income and you report you do your calculations of tax, and you pay that tax to the government. Now, like I said, it isn't saying that it's optional or voluntary to pay. The IRS does receive copies of your W-2. It receives copies from other institutions of income and various things. And so it does match. It has a system. When you file electronically or when you file paper, they upload it to that system where it can match to your W-2s and everything. So the IRS does know how much income that you're making, but it is a voluntary reporting type of system that we do have here. And as I mentioned, that there are the types of income taxes that you'll see are federal from the IRS, your state, and then local localities. Here in Ohio, we've got cities and school districts that have income taxes. So that's something that you need to be looking out for, especially as you look for a place to live and that sort of thing and how that impacts you. If you do work internationally, there are going to be some foreign income taxes, and that's a whole other can of worms and far outside the scope that we're going to be talking about here tonight. This table here is kind of showing you what the tax brackets are currently as they stand in the tax code. There are 4 methods here of how you can file: single, married filing joint, married filing separate, or head of household. And so as you can see here, the various brackets, how they go up based upon how much income that you're making. So I'm assuming most of you are probably going to be in that single type of taxpayer. And you can see kind of how much, based upon what your salary is going to be, how much tax that you're expected to, that the IRS is going to expect you to pay. Now, this is kind of what they call a progressive tax system, meaning that, as it says here, up to that first $9,875, you pay 10% on. That next, so everybody pays 10% on that first level. It goes up to that next level, up to 40,000. That tranche there, you pay 12% on, and then on up the chain. So you might make $518,402, and still you're not paying 37% on everything. It goes through those brackets. So something to consider there and something to watch out for. Something to expect for single filers. I made this as single filers because I assume that's what most of you are. I went through 3 different scenarios here of kind of what percentages overall that you'd be paying. And I'm assuming the city of Cincinnati here. So Columbus, Oxford, you're going to have different rates. So it kind of depends upon where you live. And also if you live in Ohio, if you live outside of Ohio, I mentioned I lived in Colorado. Colorado does not tax cities. Cities do not have separate taxes as they do here in Ohio. So as you go to different states, that might be something to consider there as well. But this is if you're making $50,000, this first column, if you're making $50,000, how much you're kind of going to be expected to pay in tax. You go through the different levels of things that you're going to be expected to pay tax on. You've got your federal income tax, you got your Social Security tax, Medicare, Ohio income tax, and city income tax. All in all, you're looking to be about 35% total with income taxes on $50,000. It goes up a little bit as you start making more money. So at $125,000, you're looking to be about 38%. And then, as I mentioned, we're talking to higher taxpayers such as Bengals players. They're having to pay about 50% of their 50% of their payroll goes to taxes. So, as you can see, as you get more and more income, you're gonna have to pay more and more to tax. There are some special taxes in there. As you can see, there's additional Medicare taxes for people making greater than $200,000. So as you go up, get higher wages and things like that, there are some additional taxes you need to pay. So withholding. So withholding is something that we're going to be talking about here a little bit more in detail. And withholding is something that occurs on your paycheck. Now, like we mentioned, everybody needs to be paying tax, and it is a voluntary reporting system, but the IRS still wants you to pay taxes and pay taxes on a periodic basis. If you're a W-2 employee, which most of us will be as we start out, meaning that we're employed, somebody is paying us, and we're going to have taxes withheld. That's paid on a bi-weekly or a monthly sort of period, and those taxes are paid to the government at that point in time. If you're an independent contractor or if you're out on your own, you do need to pay quarterly taxes, and that's something that we might touch on a little bit later, but maybe a little bit more out of the scope of what we're going to be doing here. So as I mentioned, withholding is something that comes out of your paycheck. Your employer pays that directly to the IRS. They withhold on your salary, and they withhold federal tax, state tax, city tax, Social Security, and Medicare. Now, the companies do have their own portion of Medicare and Social Security, which we call FICA taxes, that they will need to pay as well, but you pay your share. Withholding is on a W-4, and I've got examples of these forms here in the next couple of slides. Withholding is you kind of tell your employer how much you want to withhold. And that depends on a couple different things. It depends on the amount of income. They kind of place you into that generic bracket of 24% or 22%, whatever your salary may be. And then we go into filing status. And that kind of depends upon personal preference. And we'll kind of get into what that means. But for me, my rule of thumb has always been, at the end of the day, when I file my tax return, I don't want to have a refund or pay a little bit, because I don't want to give the government an interest-free loan. That's how I look at it. So I want to have maybe $1,000 back from the government or pay $1,000, but I want to be in that range. I don't want to have a large refund. So to do that, that's when we kind of look at our W-4 and what kind of exemptions and allowances that we need to make. And so there's a couple different things we need to think about here. We've got filing status, whether you're single or married, and that's going to depend upon how much is withheld. If you're single, you're going to have more withheld out of your paycheck because you're the sole person that's getting withheld upon. You're the only one that's paying tax. Married, that comes down a little bit because there's going to be two people that are paying in tax into the same system. So you'll want to put in an S if you're single on this W-4 form. Now, when we start talking about withholding allowances and what that claims, that's when you talk about a 1, 2, 3, or 4, anything above 0 starts saying that you want your withholding to be reduced. You're claiming these allowances to have your withholding reduced, and that means less withheld out of your paycheck, more paycheck coming to you. Now, the higher that number is, the more likelihood that you're going to be having to pay a little bit or some when you go to file your taxes. But that's just depends on your appetite and how you want to handle that. There's also a line for additional withholding. You can ask for your employer to withhold an additional $300 if you'd like. You still need to put down a number, let's say an S1, but then you want them to withhold an extra $50 per paycheck. That's your option, right, to be able to do that. And so, like I said, we'll see a W-4 here in a minute. Now, when to check your withholding, there's a couple times to check, and this is guidance right out of the IRS, right off the IRS website. Now, obviously, when you first start your job, that's the first time you declare, and a lot of times we fill those out, give it to HR, we never think or look at them ever again. But it's good to check these every now and then. You want to check them early in the year. Check them in January, when tax rates might have changed, when withholding rates might have changed, because you might want to adjust what you're withholding. If there's a lifestyle change, if you get married, you divorce, you have a child, that sort of thing might change your exemptions. If you do have children, you're going to get tax breaks and tax credits for having children, so you might not want to be withholding as much. So that's something to think about. Then also, as wage income goes up, as your wage income goes up, you might want to be withholding more or less depending upon what you have going on. And you could have a lot of income and interest, dividends, capital gains. There's a lot of people that have stock options and various things that kind of go through your W-2 that could impact capital gains. So you might want to consider that as you're going through this. And then also itemized deductions. The itemized deductions are not as big as they used to be because of the latest tax law.
Matt, I think
hey, Matt, yeah, we just lost you.
Matt, can you hear us?
Hey, Matt. Oops. To any of the audience, can you hear Matt? Can you let me know? No? Okay.
No, we can't hear him.
Okay.
But I think he realized that he was sharing his screen, he was moving slides, so.
Okay.
Probably should be back.
Okay. Oops.
No. Let's see here.
Oops. No. You know what they say, technology is great when it works.
Right.
No. Hey, Matt, while you're working on that, if you could put your screen up, we want to bring up a couple topics, if you don't mind. So until your sound comes back on. So one of the things I wanted to point out to you guys, is that so one of the things Matt mentioned is, like in Cincinnati, there's a 2.1% income tax. Okay, in Ohio, one of the things, if you live in a city, you can be taxed. Okay, they do have the right to tax your income. If you live in a township, you do not have to pay income tax. They do not have the ability to tax you. So now, again, I can't tell you what it is in other states, but I do know that's one of the interesting caveats that we have here in Ohio. So just something to keep in mind. The other thing I wanted to bring up is asking you a question. Where do you think, I'm gonna say, the young people get in trouble with taxes when it comes to withholding? Any ideas? And you can unmute yourself. Okay, so Vito.
Right number of withholdings?
Yes. Where would people get in trouble with withholdings?
Hear me now?
Now we can hear you. Okay, yay. So here's the answer. So let's say you graduate in May, you might start your job in July. And again, I'm going to use, just for the heck of it, you have a salary of $50,000, okay? But for that first year, when it comes to the IRS, what you're going to be making will be $25,000. Okay. And you've withheld some, so you're going to be at a lower income tax bracket, because again, the IRS doesn't say, oh, well, they only worked half of the year, right? To them, you made 25,000 year one. Year two, it's 50,000. That puts you up in a higher bracket. So that's one of the things a lot of, I'm gonna say, young people get caught up in, is that first full year of working, not having enough taxes withheld. So, okay, if you're back on, Matt, I'll turn it back over to you.
All right. So you can hear me now?
Yes, we can hear you.
Okay. I knew my computer does that sometimes. I don't know why.
Okay.
Work computer and technologies can be difficult sometimes. So
it's great when it works.
That's right. So one of the things on this slide, and I think it's important to show here, this website here at the bottom, it shows how to check withholding. This is straight from the IRS website. It's good to play around with your salary. This is a good withholding tax estimator, and something maybe you want to consider taking a look at before you start your first job, because this is going to help you determine how many exemptions or how many allowances that you may want, how many allowances that that you're comfortable with, single, married, that sort of thing. So this is going to help you out with that. So it's a good tool that the IRS has, and not a lot of people know about it, but it's something worthwhile. We talked a little bit about what's being withheld out of your taxes, and a couple things that kind of surprise people, especially first-time employees. You got Social Security and Medicare. You're like, what are these things? Why do I care? Why am I paying into this? And so, these are two things you're going to see that's going to be taken out of your paycheck. Social Security, is a tax that's going to be both on employers and employees. Both pay 6.2% to the Social Security program. This is mandated. It's something that has to be done. And so, if you have a salary up to $137,500, 6.2% is going to go in. If you're making $150,000, you stop being taxed on that $137 number. So for most of us, as we start off, we're below that $137,000 amount. So all of our income is going to be taxed on 6.2%, and that's going to go directly to the Social Security, and that's going to there to be benefit you upon retirement or disabilities. There are some websites out there from the Social Security Administration that you can check to see how much you've paid in and what your projected benefit's going to be. And that's something to take a look at as part of your planning process when you're looking. And I know it's early to think about retirement, but as you talk to your financial advisors on 401ks, IRAs, and things like that, this is something to think about as well. It's another source of income on your retirement. Medicare is also a tax. It's a part of the Medicare program. It's subsidized insurance benefits for when you're retired. Now, your income is going to be taxed 1.45%, and goes directly to this. Your employer's going to be taxed the same amount. So you split that 50-50 with your employer, and that's for all of your income. Now, if you start making over $200,000, there's another 0.9% that's going to go into this bucket as well. So these are going to be taken out, and something to think about as you're budgeting and thinking about what your salary is going to be. So this is what a W-2 looks like. This is what your form's going to be. I'm sure if anybody's had a job, it's probably received one of these. The boxes that we've been talking about are up there in the upper right-hand corner. Wages, the federal income tax, Social Security tax, and Medicare wages and tax. And so those boxes are going to be filled out for you. Now, your box 1 wages might not necessarily agree to what's in box 3 for your Social Security wages. And there's a couple of reasons for that, and it's something to not get worried about if you do get your W-2. If you're contributing to a company 401k plan, that's money that's coming pre-tax out of your salary and going directly to a 401k plan, and reduces that box 1 wages. it'll show up on box 12 down below as a retirement plan. So you still get taxed on the wages that you pay. You do not get taxed from a federal income tax standpoint on the wages that you're paying into a 401k, but it still goes into the Social Security and Medicare tax buckets. So those numbers will be different. Box 15 down at the bottom is where your state income taxes, your state wages, and any local taxes come through. So as you're reading this, you might see that if you're working in multiple cities, say you have a job that takes you to Cincinnati, Columbus, Dayton, Cleveland, Toledo, wherever it may be, and you're working there more than 2 weeks a year and they're having withholding out of your paycheck, you might get 2 or 3 W-2s. And those W-2s, it doesn't mean that the federal government's going to be seeing all 3 of those. What's happening is that there's not enough room for the local wages, so there's going to be additional cities attached to the back, and that's why you're receiving those. So something to consider when you get that W-2 if you're working in multiple cities. Same thing goes with multiple states as well. As we talked about a W-4, as you can see, a lot of these forms from the IRS, when it comes to payroll, start with W. So if it's a W-4, W-2, things like that, this is going to be associated with payroll and something that you might want to take a look at. This is something that HR is going to give you your first day. They're going to say, fill this out. Tell me how many exemptions you want, how many dependents you claim, and any other adjustments you want to have. So that's why it's important to maybe think about this beforehand, since probably know your salary going in, to do that estimated withholding calculator by the IRS and see what you want to have. And so that way on your first day, you can go ahead and fill this out, with the knowledge of what you want to do and not be blindsided of just trying to throw down some numbers on this.
Okay, Matt. So Alex Yurchak asked a question, and he's asked for any guidance on the impact of increasing deduction from 1 to 2 on your W-4, but he doesn't want a big surprise at the end. On the flip side, Alex did buy a house. Was it earlier this year or was it late last year? Alex?
It was a year and a half ago, October of 19.
Oh wow, I didn't realize that's
yeah.
okay.
Yeah. Yeah, I still think it's 2020. So
yeah.
So yeah.
My sound cut out. I didn't hear all the question.
So the question was, Alex was wondering if he has bought a house in the past year and a half. Should he consider increasing his withholdings from 1 to 2? And he is single. Possibly.
You need to look at that itemized deduction. It might not matter much for you, Alex. Real estate taxes and state and income taxes, when you're looking at itemized deductions, are capped at $10,000 now. Your mortgage interest deduction, depending upon what that may be, let's say it's $6,000, you're now at a $16,000 deduction. And depending upon how much you have in charitable contributions, let's say it's $4,000, you're coming to $20,000. Now, as a single, as somebody that's single, that might be beneficial to itemize. I can't recall.
Oh man, I think you dropped one, man.
Oops. Yep.
Can you hear me now?
We can hear you now.
I don't know what the itemized deductions are for a single person or off the top of my head. If you were married, it probably wouldn't make sense because that standard deduction's at $24,000. But it's something to consider, and you want to take a look at how much interest you're going to be paying and how much you'd be able to deduct. But it's definitely a calculation that you'll need to take a look at, and it's not an answer that I can say yes or no. You want to do something, we would need to take a look at that and put some numbers to paper before we say one way or the other.
Okay, sounds good. Thanks, appreciate it.
Matt, can we go back to the W-2 real quick? I just want to make sure that I would say everyone understands and including myself. So let's say number one on box 1, you made $50,000. Okay. but you had $10,000 or you withheld 10% of your income for your 401k. So what you're saying, I just want to clarify, is that on box 3, your Social Security wages, would that be the 45,000? Because, and then in box 12, it would say 5,000?
But box 1 would have the 10% decrease to it.
So it would be 45 in box 1, 50,000 in box 3, and 5,000, which is what you contributed to your 401k. So in other words, you will not be taxed for federal income tax on that $5,000, but you will be charged or taxed that $5,000 you put into your 401k. You will still have to pay Social Security as well as Medicare tax on that.
Yes. Yeah.
Okay. And so the reason I asked, I just want to give that example to all of you younger people there. Okay. That is a great way to, number one, hopefully avoid paying a bit of taxes, but let me tell you, you got to save for your future. And the sooner you can save, the better off you're going to be. Sorry. Okay.
Absolutely. Now with that, there are different options that companies have now. You have your traditional 401k. A lot of companies now are doing what they call a Roth 401k. In that case, it's post-tax dollars. So that amount will be in box 1 if it's a Roth 401k, because the gamble is that you're going to be paying less tax now than what you will be in the future. So you're going to pay into your Roth 401k with money that's been taxed now. So I think, Mary, that we talked about maybe there was going to be another webinar on some of the IRAs and 401ks later on. And so this is going to be a topic later on, but it's something to think about as you're looking at W-2 and your income. So, all right. Now, we're kind of moving on here. Did want to point out, since most of us are in Ohio, potentially going to be working in Ohio, and maybe some of you are new to Ohio and might stay here in Ohio. Something that's fairly unique to Ohio is that Ohio allows for cities and school districts to impose local income taxes and then collect that through employer withholding taxes. Each city's free to set its own rates. Right now, Ohio or Cincinnati's at 2.1%. It will decrease to 1.8. We did go through that recently, where that's going to decrease. I think that's starting here in 2021. Columbus is at a 2.5% rate. So there's going to be various cities that are going to be taxing jurisdictions. I live in an area that's called Anderson Township. That's a non-taxing jurisdiction. So if I worked close to where I live in Anderson Township, I would not have any city tax. So to give that a little bit of a background, kind of depend, you got things going on here. So I work in Cincinnati. I don't live in Cincinnati, but I pay a Cincinnati income tax. It's withheld out of my taxes because that's where I work. If I lived in another city that also had income tax, I would not be paying income taxes at both places. Most cities give a credit for taxes paid to wherever you work. So don't think that you're going to get double taxed. However, here in the past year, as you can kind of see that a lot of people are working remote. There's a lot of, with COVID, many people are working from home. Got it now? Apologize for that. So we got a lot of people working remote now, working from other places. So for me, I have been going downtown, but there's people in my office that work in Cincinnati, but haven't stepped foot in an office since March. And Cincinnati's still taxing them. They're not receiving services at Cincinnati. They don't vote in Cincinnati or anything like that. and they're saying, why am I still paying Cincinnati income taxes when I'm not getting any benefits? I'm not working downtown. I'm working from my living room or my bedroom, and I'm working out of Mason, which might be a 1% tax rate. So why am I paying 2%? And there's a lot of people in government that agree with that in the State House that are saying that you shouldn't be taxed upon that. You should not have to pay tax on places that you're not getting any benefits from just because your company might be headquartered there and you've worked there. That's where your normal working location is. Cities are pushing back on this and saying, hey, wait a minute, your employer's still located here. You have office space here. We have a right to collect taxes on you, and we need our 2% tax because we need to run our services. We need to run the fire department. We need to run the police department. And that's going to leave a big hole in. Can you hear me now?
I can hear you now.
Yes.
So they say that there's going to be a big hole in their city budgets if they don't apply this tax. So there's a big fight that's brewing. There's a Senate bill, there's a House bill in the State House right now trying to go and combat this and saying, hey, you should pay tax based upon where you're working. And that's kind of been how it has been in the past. I mean, I work in Cincinnati, but I could be working out of our Kentucky location 2 days a week for a couple months. I can apply to Cincinnati and say, hey, I've been working in Kentucky for these past few days. I've worked there for 30 days out of this past year. Therefore, I shouldn't be paying city taxes on that. There's a form that the city of Cincinnati has, and that needs to be signed by your HR director, and they will give you your money back. However, with this COVID and everybody working from home, there are less and less likely to do that and allow for that. So it's something that we're going to see fought over here probably in the next 6 to 9 months. So we'll see what happens there. But it's to be determined. But it's definitely a big fight that's on the horizon. One of the things that I would say that if your company does offer work from home, remote work, that sort of thing, when you start, ask to not be placed in a city. Say, hey, code me as a remote worker or work from home. So this is getting more and more. Hear me now?
Yes. All
right. So something to think about, something to consider as you get into the workforce and what's going to happen with city taxes. So with that, I'm going to bring some IRS facts here at the end, just to kind of throw them your way. Just some various things that, from the tax world here. I'm sure, I don't know, maybe many of you have heard of Al Capone, famous mobster back in Chicago in the early 1900s. The FBI and police could not take him down, but the IRS did. They couldn't get him on anything other than tax evasion. So the IRS is very powerful and is something that you really don't want to mess with. In 2019, the IRS collected almost $3.5 billion or trillion dollars in taxes. That's a lot of money. That's something that that they are going to enforce. The IRS processed 253 billion income tax returns, and of that, it's common that almost 6.6% of individual returns get audited. Doesn't seem like a lot, but there are different types of examinations. What this number is like physical audits. Like I mentioned earlier, the IRS has mechanisms to do matching programs. So you still may get a notice on a matching thing, a matching item where you may have reported income being $50,000, but on your W-2 it's $52,000. and they know that, and they might send you a notice. So just keep that in mind. You might not be a full-fledged audit, but there are other mechanisms out there where they will touch base with you. I did put a dollar sign on that. That shouldn't be $771,000. That's just almost 771,000 tax returns were audited in 2019, which resulted in $17.3 billion in recommended additional tax. So there are various things. It's not necessarily people are cheating taxes. People just don't know tax laws, or the IRS has a different opinion than what us tax professionals have, and some of these go to tax court. So if you're in tax, you will hear a lot of times there's no right or wrong answer. It just depends. What answer do you want it to be? And we'll get there. It's not tax fraud. It's finding that right code, right part of the tax code to get where we want to be. And that brings me to the last slide here, and something I want to warn everybody about: tax scams. There's a lot of things going on out there. I'm sure you guys see a lot of phishing emails and various things. The IRS has been able to catch a lot of fraudulent tax returns over the past few years, filed on other people's behalves, and they are stopping that more and more to where those are going down. You may now start receiving calls. All right. You may receive some calls from people claiming to be the IRS. Just want to let everybody know the IRS will never call. Can you hear me now? So just know the IRS will never call to initiate anything with you. They will first send you correspondence in the mail. They will use the U.S. mail. So if somebody calls claiming they're from the IRS, just hang up. Don't engage. There are a lot of scams out there. And something also to take note with COVID and Ohio unemployment, there have been a lot of fraudulent unemployment claims made over the past year, and many people, and my clients even, have received 1099s from the state of Ohio saying that they received Ohio benefits in the past year when they did not. If that happens, you need to contact the state of Ohio and let them know that you received this and you did not receive any unemployment benefits. Governor Voinovich or Governor DeWine even received one of these as well. Someone was so bold to even put his name on one of these. So nobody's immune. Don't panic if you get something like that. Just go to the proper channels and it will be taken care of. But it is something to keep in mind. Protect your information, protect your social security numbers so this doesn't happen to you. And with that, do we have any questions or any further clarifications on anything that we need to go through?
I'll ask you a quick question or get your thoughts on something. Now you mentioned that the IRS basically has, they know what your numbers are without you filling out the forms. Is there any possibility in the future we won't even have to fill them out? They would just calculate them and let us know what we owe them?
Possibly, you never know. The IRS, it's not a perfect system by any means right now. You will get matching notices and they're not correct. I have had clients that received said from the IRS and said, we received a 1099 that said that from your brokerage statement saying that you had sales proceeds of $10,000. You're claiming a $5,000 loss. Why is that? Well, because the broker did not provide basis, and so you need to reply to that. The IRS doesn't know that there was basis there to create a loss. So there are instances where this won't happen. In a perfect world, I think that's where the IRS wants to be, but everybody has to be on the same page. All financial advisors, all as I was saying, I think everybody will need to be on the same page for that to happen, financial advisors, employers. But I just don't think it'll ever happen. In a perfect world, yes. I think there's just too many moving parts for that to happen.
Okay. Not that I was trying to put you out of business or anything.
No, no.
One of the reasons I asked the question about the voluntary versus involuntary is that early in the presentation is that every so often there is some tax guru who comes out and claims that you don't have to pay taxes because because it is a voluntary system, and every one of those people ends up going to jail. So I was going to ask you, Matt, if you ever had any problems with anyone being in that situation where they followed someone who gave that advice.
No, never had that situation. Yes, you do see those out there. They're very far and few between. No, I have not seen anybody that is taking that position. Part of it is because, as you said, that it's a voluntary versus involuntary. The other part of it is just basically the history of income taxes themselves. It started back in the 1800s after the Civil War, where the government needed money, so they imposed a income tax, and courts at that time deemed that it was illegal to do that. And that's when the 16th Amendment was passed and ratified to allow for income taxes to be allowed. So some people still kind of say, well, the court said this, but that was sometimes, in most cases, that was before that amendment was passed. Now, there have been other cases around wealth taxes. There are, we've heard that a little bit in the past election about wealth taxes and things like that. And that is actually excluded. Wealth tax is not permitted by law, only income tax. So now, in order for wealth taxes to be allowed, there's going to have to be some major hoops to be for Congress and DC to jump through in order for any of that to happen.
Alex Yurchak asked another question. He says, besides the work from home impact, anything else we should be on the lookout for potential impact? And I assume, Alex Yurchak, you're referring to any upcoming changes? Is that what you're asking?
Yeah. So any type of changes that we should be on the lookout for, besides like working from home, etc.
That's the biggest one in play right now. I mean, obviously, we've got a new administration in DC, and a lot of the tax law changes that happened 2 years ago are likely to be changed. What that will be, we don't know. And it could be piecemeal. The way that DC works right now, there's a lot of belly aching and a lot of infighting, and there's going to be. I don't think we're going to see major overhauls, even though we probably will, but likely we're going to see a lot of small things that happen. And one of the small things that occurred today was around child care tax credits. So, with the new stimulus, we could see some additional child care credits out there that could be in retroactive to 2020, but we're not sure. That's just something they're talking about in DC. And they're also talking about the stimulus payments and about putting further limitations on those. So it's a fluid sort of thing going on right now, and probably have more clarity on that piece in the stimulus stuff by the end of the week. But as for individuals ourselves, obviously rates change a little bit year to year due to inflation and things like that. So it's something to take in consideration. But there's really no large impacts that we need to be looking for, at least in the short term.
So one question I have, Matt, is regarding the working from home. And at least at one point, you were able to write off a portion of your house, let's say a portion of your office, your home office, if you did work from home. But I do believe that that only applies if, can you no longer do that?
Go on, finish your question.
Oh, I was going to ask, but doesn't it have to be like its own separate room?
If you're an employee, no, you cannot. If you're employed by a company, you cannot take that deduction, have that office space. Now, if you have your own company and you work out of your house, there are some things you can do there, and based on square footage, based upon rooms and various things. But if you're an employee, no, you cannot take that deduction.
And if I recall correctly, that was part of the Trump tax plan from a couple years ago, as they got rid of the employee's ability to write off some business expenses. Is that correct?
But part of that, that tax law, yes, there was some changes around business deductions for employees that you can no longer take that. Yeah.
Okay. So I have a question for all of the young people, those of you who are still in college or recently out of college. When you hear us talking about taxes, what is, it's a little bit different than you're going into your tax class. What are you thinking? What is your opinion of this? And please unmute yourself. I would love to hear what you guys think.
Guess I'd just say I'm not looking forward to having to pay them.
Okay, that's a very good response. So anything else?
It's a great skill to have, kind of moving forward. You can kind of work the system in your favor, whatever way you can to save as much money as possible.
Okay. Are you an accounting major, Adam?
I am a finance major.
You're a finance major. Okay. Any other comments from the audience? Would love to hear what you're thinking as you hear this conversation.
I was going to throw something out there. Just now, a number of years ago, they added to the tax W-2. You'll see it on there. Some of your benefits, which are not taxed. So, for example, health insurance. And sometimes. If you're unaware of how much your company's paying for it, that figure's actually out on that W-2 form. And there was some talk, the reason why they put it out there was at some point they were seriously discussing taxing that, because not everyone gets the same benefit. Obviously, if you work for a corporation that pays a lot of items like that, you're getting a free ride. Whereas if someone else had to pay for that out of their pocket to buy insurance, they're paying tax, they're paying with that after tax money, right?
That's something that, like you said, that they talked about. The fear was, including that on your W-2, that they would tax that at some point in time. There hasn't been too many discussions on that recently, but that's definitely something that could definitely happen in the future.
Hi, Matt. Gail here.
Hi, Gail.
Hi, Mary and everybody. Hi, husband. It was my understanding in terms of withholding that if you did not have at least 90% of your taxes withheld, that you could be hit with a penalty. So is that still, is that still the case?
Yeah, yes and no. So here's the rule on that, and it's based upon the amount of income that you have. And I don't know what the rule is for single filers off the top of my head, but it's $150,000 for people married filing joint. If you make over that threshold, the rule is that you need to pay in 90% of current year tax or 110% of prior year tax into the federal government within the 12 months within the tax year, or else they will apply what they call penalties. Basically, it's interest. So it's not a substantial amount, but it can add up. I've seen some be closer to $8,000 on people not having, was it $600,000 what they needed to have in there. So it can add up, but yeah, that's the rules. It's called safe harbor. It's prior year safe harbor is 110% of prior year AGI, and so you have to have 110% of taxes or 90% of current year.
Okay, thank you. So you couldn't do your W-4 so that you'd only be paying in, say, like 50%. Then you would probably get penalties. So
right.
keep
right.
that in mind when you check your boxes on how much you have withheld. And you talked about plus or minus 1,000 for your personal planning that is good for you. And I think Jim and I also kind of target that.
Yeah, I think it was about 120 bucks last year.
What, that we paid?
Yeah, we paid that, but
we paid 120. We were owed 120 extra dollars,
yeah.
not total dollars, to the feds, right? To the the federal income. Good job, Jim.
I was very proud of myself. I got Claire down to $1, but that was
Claire is one of our daughters. Our Claire, right, James?
Yep.
He has a Claire too.
Oh, that is Claire. Okay.
So one other question for all the collegians out there. Okay, so let's say, for example, you have your own business or you have your side gig going and you're an independent contractor. So how much do you have to pay in Social Security? You know, so what, Matt, what is the current rate? Is it 6.75?
It's right around there. Okay, 6.5. So, yeah,
okay. So as an employee, okay, let's say it's 6.5, just to make it easy. Okay, I pay 6.5%, comes right off the top, up into the 137, right? Okay, and then my employer does the exact same thing. If you are an independent contractor, you have to pay the 6.5 for you, and your boss pays the 6.5. Who's your boss if you work for yourself? You are.
You are, yeah.
Right. Okay. So just will make sure you understand that. And of course, the same thing would be true of the Medicare tax as well, which I'm sure I'm like a ray of sunshine for all of you right now. I'm sure a few of you are turning green hearing that, but you know what? I'd rather you hear it here. So it's something you plan and think about in the future than to be surprised. Because, you know, let me ask you this, Matt, if you had to choose between dealing with the IRS and the mob, who would you prefer to deal with?
Well, I deal with the IRS on a daily basis, and I know how to work my way with them. So, but yes, you're right. I mean, they can be difficult and unreasonable, and so you don't want to. If you don't deal, the best thing is not to have to deal with them on major items. And as Mary was talking about, the self-employment tax, that is a big thing and something that you need to consider. You do get a deduction on that additional self-employment tax that you do pay. There is a small deduction associated with that. So there is a little bit of benefit there. So something to think about if you do have your own business. There are other things, if you do have your own business or if you're an independent contractor, other things to think about in retirement planning and things like that, where you can get some deductions on that as well. So if you find yourself in that position, definitely talk to a CPA, talk to a financial advisor, and get get the right things in place and get it done appropriately, and not try to do it kind of half-assed, because I've seen some people get burned by that.
Okay. So any other questions? You know, free field to unmute or chat them in. We are right now at 9 o'clock. Just a couple other, I'm gonna say, housekeeping items. Assuming that everything was recorded, which the reason I say that is because last week we had a little issue. We're trying to find where that recording went, but we will send this all out to you as well. Matt, again, is president of our alumni chapter. So, you know, if you want to reach out to him, or have him come and talk to your chapter, virtually, I should say, I'm sure he is more than happy to do that. Of course, I just put you on the spot there, Matt. Of course, let me also say it's going into tax season, so that could change within the next few weeks when everything starts going haywire. We do have 3 more webinars coming up. The next one is about buying your first house. Why do you want to do that? Alex Yurchak, because you want to, be able to write that off on your taxes. And the other one I will mention is the one after that, okay, which is coming up. It will be, I'm going to say March 22nd. It's going to be about your benefits from HR. If you are a graduating senior, please consider that my personal graduation gift to you. Okay, because you will be going into a room, and just like on the W-4s that you had to fill out, right? W-4s, you're gonna have to fill out some things and you have no idea what's coming at you. We want to prepare you for that. Even if you're not graduating, it is worth your time, because one day that will be you filling out those forms. So just want to put a plug in that. Again, it's my personal gift to all of you. Okay, so hope you will accept that gift and in the intention given. Again, there's several of us from the Cincinnati Alumni Chapter here. We want to thank you for joining us this evening, and we look forward to seeing you on future workshops. We want to thank James Kuhn for helping us out, okay, by lending us the Zoom account, and of course to Matt Whitehead for doing this presentation for us. So if you need to reach me or Matt or anyone for the Alumni Chapter, please don't hesitate to call us. We're here to help you. So with that, we'll go ahead and end recording, and thanking you all for being here tonight. Thanks, guys. And we really do look forward to seeing you all in person sometime soon.